Good morning, friends, and welcome to this session on risk management and capital conservation. It's a sequel to the sessions we had earlier on risk management. So in this session, Dr. Farid will be reinforcing the concepts which were already explained during the sessions on risk management, and he will develop it further to take you to how these concepts can be used for conservation of capital in a bank. So it's a very important session for all of us in practicality as well as for understanding. And now I request Farid sir to start his presentation. I'm just permitting that.
Good morning, Tansale ji, Rao ji, Bhaskar Sen ji, and Mr. Arvind ji. And good morning, friends. Already there were two sessions on risk management and Basel Accords, but this session I will take the outer line or superficially the Basel norms and risk management little detail, and also the capital conservation, how it is important and how we can go about it for the banking industry. So the session will be in two parts. First one will be the risk and risk management. The second one will be the Basel Accords and capital conservation. The first session, it may take around 1 hour, and the second session also equally. So we may have a break of 5 to 10 minutes if we want. So first, risk management, we will start now. So what is risk? What is a risk? See, generally the people are accustomed to use risk and uncertainty similar words, but there is a difference between both of them. If you see, is it a risky to cross an unfamiliar chance? It depends all whether you find a bridge or a tightrope, how it will be. So the uncertainty is you simply don't know yet what it is. But risk is you know enough to assign a probability how you can cross. So uncertainty implies a situation where the future events are not known. Whereas risk, there is you know with a probability. So there is a little difference between the uncertainty and risk. The uncertainty or risk depends upon, when we can explain with this map, FAQs, the facts, assumptions, questions, and surprises. The facts means we know what we know. Assumptions, we know what we think. Questions, we know what we don't know. And surprises, we don't know what we don't. So we have to understand the facts, assumptions, and questions which we are aware to, and we have to discover the surprises which we are not aware before surprises discover us, so that we can take mitigative steps. So the level of uncertainty increases from the facts to surprises. There are more facts which you know, the certainty will be there, the uncertainty will be at a lesser level, whereas as the continuum increases from facts to surprises, the uncertainty increases. Then coming to the concept of risk. In fact, the risk is the effect of uncertainty on objectives. The result of uncertainty on objectives. Always the risk does not mean that it is negative. It is both positive and negative consequences of uncertainty. Because uncertainty is inherent in every business, it cannot be avoided, as it is very difficult to predict about the future. So because we cannot predict about the future, uncertainty will prevail. Uncertainty will be responsible for risk. As I said, uncertainty may be positive or negative. So as the risk is also positive or negative. Risk is also not avoidable as long as we don't know the future, what the future will bring to us. So as I said, if risk refers to both positive and negative consequences of uncertainty. All uncertainties are not risks, but all risks are part of the uncertainties. So risk is the probability of winning or losing something worthy is known as risk. This FAQs map, when you analyze it, you will come to know its impact. When the facts are, you know better, the impact of the uncertainty will be less, and it will increases with the towards the surprises. Sometimes the small dots indicate that the impact is less of surprises or assumptions or questions or facts, and it is going on, it may be moderate. Sometimes the impact of facts or assumptions, questions and surprises will be more, which are represented by the bigger dots, which says that you have to focus the high impact of the facts, high impact of the assumptions, high impact of the questions, and high impact of the surprises, which is most important to mitigate the risk or to mitigate the uncertainties. But generally in practice, what we will think is unfavorable outcome of uncertainty is treated as risk, though risk is both positive and negative uncertainties. So once in practice, when we are talking the risk as an unfavorable outcome of uncertainty, the risk is can be defined as risk is the possibility of loss that may arise due to uncertainties. Then how it is a possibility of loss? Uncertainties lead to variations in the net cash flow, which may be favorable or unfavorable. But this is how that net cash flow variation is happening that decides the level of risk. If the lower variation in the net cash flow, the risk will be low. Higher variation, risk will be high, and no variation, that means there is no risk. As far as any business is concerned, uncertainty is sure. So in banking, the uncertainty will impact the net interest margin or the trading profit or credit quality, system failure, process failure, and impact on the economy as a whole because of the uncertainties in the banking industry. If you take even as a business in general, a business will do, anybody will do the business with an objective. The objective will be profit or to achieve certain goal, social goal. So, but as far as the financial risks are concerned, there are uncertainties. Either the incurring the loss or a reduction in the profit, which is or shortage in the liquidity. So when you take the profit and loss, the uncertainty will impact the reduction of the profit or the incurring the loss. This is called the risk. How statistically risk will be measured? Risk is nothing but comparing the actual and expected return. The variation between the actual and expected return is the risk. It can be measured by statistically by a dispersion around a future expected value. That is generally an average value will be taken, and whatever the dispersion happens around it, it will be treated as a risk. Risk is always an estimate. Risk is tied to the profit because profit is the reward for taking the risk. So as we said that more risk, higher variation, higher risk and higher profits, or the lower variation or lower risk, lower profit. So risk is tied to profit because as per economic theory, the risk is a profit is a reward for taking the risk. The relationship between the risk, capital and return. The volatile returns are the features of a risky business. If the time horizon about during which we are estimating the risk is longer, the uncertainty will be higher. So the risk will be higher. So longer time horizon represents higher uncertainty and a higher riskiness in the business. Capital. Capital is cushion for business loss absorption. You are all aware that main objective, most of the time at a lower level, people will think that the capital is required for doing the business. Capital is required for doing the business, but the main objective of the capital is to absorb the losses, to meet the losses. So capital is a cushion for business loss absorption. So risky businesses need higher capital. And always, whenever you calculate the returns to compare two investments or five investments to choose one among them, always you have to make a risk adjustment for comparison between the returns of various projects. So this is the relationship between the risk capital and returns. So friends, I hope you understood the difference between uncertainty and risk. Risk is probability of happening, the impact of the uncertainty. Then coming to the types of bank risks. Risk in banking, both financial and non-financial. Non-financial risk also may result sometimes in the financial losses or the financial into the losses like operational risk. But financial and non-financial risk are the broad two categories of risk in the banking. Under financial risk, credit risk, which is again subdivided into the counterpart risk or borrower risk, intrinsic risk or industry risk, portfolio risk or the concentration risk, and the market risk is again having the important components like interest rate risk, liquidity rate risk, currency or forex risk, hedging risk. Whereas coming to the non-financial risk, operational risk, strategic risk, funding risk, political risk, legal risk. And other than this, there are some other risks we will discuss a little later. Coming to the credit risk is the potentiality of a borrower or the probability of a borrower or counterparty failing to meet its obligation. Under this, counterparty risk is linked with the inability or unwillingness of a customer or a counterparty to meet its commitments relating to trading, hedging, settlements, and other financial transactions under the agreement. He may not be stick on to the schedule of repayment. Then country risk and sovereign risk are used as a similar words, but there is a little difference between these two words. Country risk is when the non-performance of a borrower in the foreign country is generally attributed to the economic conditions of the country, whereas sovereign risk is a non-performance of a borrower beyond the control of the borrower, like sovereign restrictions on honoring the external obligations. The first one is on the economic conditions, whereas second one is the sovereign restrictions on honoring external obligations. Then industry risk under credit risk is that these are the factors that can impact a particular industry, which can in turn affect the companies within the sector and thereby the banks. Portfolio risk is a chance that the combination of assets within loans that the banks own ran into meeting the financial objectives. The remedy or mitigation for portfolio risk is, as we are all aware, it is the diversification of our portfolios. Coming to the market risk, it is the risk that the value of on or off balance sheet positions will be adversely affected in equity, affected by movements in the equity and interest rate markets, currency exchange rates, and commodity prices. In fact, the changes in the market risk or the quantum of market risk causes substantial changes in income and economic value of the banks. Under the market risk, the interest rate risk is one of the market risk. It is the risk where value of investment changes as a result of the change in the interest rates, and interest rate risks are due to adverse interest movements. The volatility in interest rate mostly affects the value of bonds. So it will have an impact on the earnings of the bank. It will have impact on the economic activity, and also off-balance sheet exposures like derivatives will have impact on the impact of the interest rate. So all this is very one of the very important risk under market risk, which affect the bank's profit to a large extent. Equity risk, this is a capital market risk, generally referred to as a risk that arises due to volatilities, mainly stock prices and operations. A risk weight of 2.5% has been prescribed for investment in government and other securities, approved securities, 100% on the open position when Basel was first time, Basel 1 was introduced to assess the capital market risk in a simple way. Then the other type of market risk is foreign exchange rate risk. The foreign exchange rate risk arises when the financial instruments held in the foreign currency. The value of foreign currency asset changes as and when the exchange rate of the foreign currency fluctuates. So it will have impact of a foreign exchange rate risk. Operational risk. As we are all aware, operational risk is defined as the risk of direct or indirect loss resulting from the inadequate or failed internal processes and procedures, people, systems, and external events. In fact, the Basel II projected the 7 causes of operational risk. One is internal fraud, external frauds, employees' practices and workplace safety, clients' products and business practices, damage to physical assets, business disruption and system failures, execution, delivery, and process management. So whatever we have defined operational risk, if you see the definition of the operational risk, these 7 components are nothing but the part of the definition of the operations. This, as you are aware, acts of the fraud committed internally in an organization go against the interest of the organization, and it will lead to the losses. So internal frauds. External frauds committed by the parties against the bank, that also causes losses to the bank. Then employment practices and workplace safety, the corporate governance, the discipline, the systems and procedures, all those things will affect compliances, will affect the level of operational risk. The latest and very important operational risk is the cyber risk, because digitization has increased substantially, and along with the digitization, level of digitization, the operational risk also increased to the maximum level, I can say, which is most important operational risk nowadays the banks are facing. Then, as we discussed the financial and non-financial risks, and also under non-financial risk, we have discussed the operational risk. In fact, the credit risk, market risk, and operational risk, these are the most important risks of the banking industry. And other bank risks are the liquidity risk, business risk, reputation risk, systematic risk, compliance risk, political risk, and moral hazard. Liquidity risk arises when a bank fails to meet its contractual obligation. In extreme cases, not able to fund the liquidity gap, resulting into the default. There are 3 different circumstances under which liquidity risk will happen. Funding risk, net outflows due to unanticipated withdrawal or non-renewal of matured deposits. Time risk, non-receipt of expected inflows because of the accounts are becoming stressful and the non-performing assets. And sometimes call risks, that is a crystallization of contingent liabilities. So in addition to those three risks, the liquidity risk is another very important from the banking point of view. Systematic risk, it is the erosion of the bank's liquidity position due to disruptions in a bank's regular source of fund. Such erosion could trigger sometimes a severe instability and collapse of the entire banking industry itself, and thereby the economy under certain happenings. Then business risks, this will generally, one example is now the fintechs are coming, private banks are coming, new private banks are coming. So the banks may face a competition or a business risk, because to compete with them, the banks are going for a new products, collaborations, co-lending, all those things they may select one strategy. The chosen strategy itself may go wrong, which will have the impact on the business of the bank. Reputation risk, you are all aware, whenever the services are not up to the expected level of the customers, or some fraud happens, either external or internal, or also it may occur due to once that customers are not and we are not able to meet the customer requirements, whatever they are expected, that also affects the reputation of the bank. Then compliance risk, you are all aware, the Reserve Bank of India being a regulator, it is giving a lot of thrust and the focus on the compliance, because the compliance and the corporate governance, they will go hand by hand, and it will have a lot of impact on all other risks, particularly operational risk and the credit risk. But not only operational risk and credit risk, this compliance risk, if the bank follows or complied with the norms which are required as per the regulator or on its own, not just for the compliance sake, as per the culture of the organization, it takes care of all other risks. Political risk, this will due to the abrupt changes in the investment policies of a sovereign or the policy or foreign policy decision of a country, which may have affect the investments made in other countries, and which will have the impact on the banking also. And mostly moral hazard, this is actually, it is not a banking risk, but it will have a mindset in the bankers that if the loan accounts goes bad, and its capital is eroded because of that, the government of India, the owner of the banks, may infuse the capital. So it will create the moral hazard on the bank, which will have the impact on the taxpayers of the country in which banks operate. So even the legal hazard also there, certain legal decisions, you are all aware that sometimes courts have cancelled the coal allocation, or sometimes other decisions, all those things also affect the banking industry indirectly or directly, because the legal decisions have affected the credit quality, thereby affected the banking.